I want to transition now talking about how we underwrite franchise brands and sort of flow into the fund report with a little bit of a conversation about prudent lending and what that has to do with franchise loans and what, if anything, is said in the SOP about prudent lending and franchise loans. As I was preparing for this session, I had a little bit of fun with ChatGPT, and I decided, hey, let's take the whole SOP. So we take the whole SBA SOP 50.10.7, feed it into ChatGPT, and just ask it, are the words prudent lending ever used in the SBA SOP? And it goes on and says, yeah, absolutely. Prudent lending is indeed used in the SOP. Here are all the instances where it's mentioned. And it goes here, it's here, it's here, it goes over. So I'm thinking, okay, but do they actually define what prudent lending actually means? They define what prudent lending standards are. And it said, no, the SBA SOP 50.10.7.1 document does not provide a specific detailed definition of prudent lending standards. Instead, it emphasizes that lenders should follow commercially reasonable and prudent practices consistent with those used for similarly sized non-SBA guaranteed mortgage loans. Now, I know that folks that are in this space and are, doing combat with the SOP, this is the part that frustrates them the most. We talk about prudent lending and that we should be using prudent lending and all these ideas around it. But this prudent lending at its core is never really defined. There's no bright lines about what prudent lending is. It's more of a feeling. It's more of, do it like you do another type of loan. But prudent lending is never defined. So it's kind of a trick question or a red herring to say we're going to talk about prudent lending because we can't really talk about it. We don't know what it is. But we can look to see with respect to franchise loans, does the SBA SOP say anything about what we should be doing if we have a franchise loan under this idea of prudent lending and the idea of the SOP? And what's interesting is that the SOP actually does talk specifically about what to do when there's a franchise loan. So when we dive in there, it speaks specifically to franchise loans in 4 different places, and 3 of them are under the underwriting standards for 7A, loans greater than 500K. And it's also the same language as in the cap lines part of the SOP and the international trade. And it talks about, well, what's the information that we should be getting when we're doing a loan? How do we analyze this properly? One of the bullet points says a discussion of other relevant information. For example, if the application involves a franchise, lender must review any credit information provided, such as the number of failed franchisees and cash flow projections provided by the franchisor. A lot of the time, that's going to be in their publicly available documents. That's going to be in their franchise disclosure document. And you may have a franchisor that didn't disclose financials in that document. So we need to reach out to the brand to learn a little bit more about what's happening with failed franchisees. Do I have closures? What are the statuses by which a unit closed? We're going to look at 4 different statuses by which a unit can leave the system. So what does failed mean? How do we determine that? All this stuff is really important to pay attention to, especially if we're dealing with a franchise loan in any of these areas. And I know that a lot of the folks on the call are doing 7A loans greater than 500K. It also mentioned it within the CDC credit memorandum in a section around independent studies or reports, saying that reports prepared independently of the business may be beneficial to mitigating any weaknesses identified in the credit analysis. And they mentioned specifically franchise assessment reports. So a third-party analysis of the franchise might be beneficial for our CDC in mitigating any kind of credit weakness that's identified there. And that's very much how we employ and use our fund report and score that we're going to talk about a little bit later in the call. So prudent lending is a tough topic. You really can't pin the SBA down on it, but they give us some hints about the types of things that we should be doing when there's an SBA loan or a franchise loan that comes across our desk in the SBA space. So I've sort of been leading the witness the entire time to sort of say, okay, well, how do we help Frandata, and how do Frandata help lenders evaluate franchise performance and meet those SBA SOP requirements? Well, the primary way we do it is with our fund report, and that is very much like a FICO score for a franchise brand. It looks at brand performance on both the unit level and the system level, and looks at both qualitative and quantitative measures. We're going to go through a fund report here in a sec, but there's an important distinction between what is an emerging brand and what is a mature brand. So I want to go through that with you. And then after we look at the fund reports, we're going to take a couple of slides on emerging brands and what makes them unique. So the emerging brand part is something that we went over last time, but I think it's something that we should reinforce again today. The major differences between emerging and mature, as you may have already inferred, is a factor of size. And FranData considers an emerging brand as any concept that has less than 50 franchise units in the United States and less than 5 years in franchising, meaning 5 years worth of FDDs. We only do a fund report, that scored report that we're going to look at on a mature brand, brands that have more than 5 years, 50 units. And the major reason for that is we're looking for a certain amount of seasoning in these franchise units before we evaluate them against a standard methodology. Most of the time, and we have a couple slides to show you this, but if a new brand, emerging brand is going to lose units, they're going to lose them in year 3, year 4, and year 5. They're typically not going to start to lose units in year 1 and year 2. Most of the folks on this call have heard this idea that, hey, most small businesses fail, whatever, within the first 5 years, but a lot of them don't fail within the first year. And that's why we don't want to do things like, historical success and looking at different performance metrics on a brand that doesn't have that level of seasoning yet in the report. So for emerging brands, we still look at a lot of the same performance categories and their financial information, but we do it in the context of how much information is available, and we don't put a score on that report. So those are still available. We call them emerging brand reports, but we do make a distinction between size and maturity when we determine, can we actually do a fund report? So that's really, really important. And it really is around availability of information. Naturally, mature brands are going to have more performance information available. Emerging brands just have less to go on, less to hang your hat on when it comes to evaluating their performance as a franchise concept. We're going to talk about fund reports and scores, but it's also important to sort of frame this and understand, well, what's a good score? What's a bad score? Help me get my feet wet on fund scores before we dive all the way in. We talked about that it's an independent risk analysis. There's 12 categories. The maximum score that you can get on a fund report is 950 points. Most of our subscribers look at top tier franchise credit at around a 750 or better. Some will look at it as 700 or better. Some will be 650 or 680 or better. It all really has to do with the bank's credit appetite, their footprint, the types of deals that they're driving through the institution. But generally speaking, 700, 750 or better means a top tier franchise credit. And this sort of shows us the distribution of top performing brands across sector and industry. And some of my other webinars, I talk about how, franchising is not just about large national food brands. Well, top performing franchising is also not about food as well. There are a lot of other, sectors and industries that have top performing concepts. Child related is right at the top of this. And we think of brands like Goddard and Primrose and Kitty as sort of the big 3 in early childhood education. They have really great fund scores along with that. So, it's about different sectors and industries when we talk about where the best performers are. But again, most of our subscribers look at top tier at about a 700. Now, I've been promising and teasing a live look at a fund report, and today we're going to go and look at last year's fund report, the 2023 fund report for a brand called Chicken Salad Chick. Now, some lenders on the call might know this brand. They are top performing. They have been growing very steadily throughout the last couple of years. And as you can see, when we open up a fund report, at the top of the report, we have sort of the geographic distribution and the footprint of this concept. And you can see they've been growing incrementally and slowly out of the Southeast and now expanding into the middle of the country and up the East Coast and a little bit down to the Midwest. So 159 units in this concept. We can see how many states there are, how many corporate-owned units they have. This is important to look at. Most brands are going to have a couple of corporate-owned units. They don't typically disclose the financials, but it's important to see, does this brand, have a foot in the marketplace? That's often what brands will use their company-owned units to do. They're getting a pace of what's happening on the ground, changes in the revenue. They have a training ground to test new menu options and new build-out configurations and things like that. So it's important for a brand to have some degree of company-owned units. That's a large number, so we don't typically see that many company-owned units, but that can happen. But you can see right at the top is our score, 760. That's again out of 950 points. And the first category of the fund report is historical unit success. So as I said, there's 12 categories. It looks at both unit level performance and system level performance. So what's going on with the units of Chicken Salad Chick on the ground would be the system level. Franchisor would be Simply Southern Restaurant Group, the entity that owns this franchise concept, that is selling the franchises, that's collecting the royalties. And we're looking at both qualitative and quantitative measures. So quantitative measure would be something like historical unit success, which we can see right off the bat. A qualitative measure would be something like franchisor-franchisee relationship, which looks at litigations that might be present between the brand and its franchisees. I'm going to go through these categories quickly so you can get a sense of them and understand a little bit about where the information comes from and how you might leverage it inside of a package for a franchise law that you might have yourself. Historical unit success is simply that. It's looking to see how's this brand performed over the last 8 years worth of performance. And from a compounded perspective, how does that brand benchmark against all brands in franchising? When we say inter-year performance, we're going back 8 years. So you can see this report, we've gone back to 2015. When we say inter-year performance, what we're doing is we're looking at the disclosures. And I have an example document here from a different brand from F45 Training. We're looking at the disclosures for the brand, and we're focusing in on unit outcomes, right? And that was something that was mentioned in the SOP. So this is sort of a thumbnail that you can take back to address that. But we're looking at unit outcomes. How many units did we have at the beginning of the year? How many units did we have at the end of the year? How many units did we open? But then how many units did we lose? And how many units did we lose in 4 specific areas? And those are termination, non-renewal, reacquired, and ceased operations other. 2 of these are a negative outcome for a bank and will thus result in lost points in success rate in the fund report. Those 2 statuses are termination and ceased operations other. Termination means the franchisor terminated our franchisee for some breach of the franchise agreement. Typically, in those cases, the loan is not repaid. And ceased operations other is the other way around. That's the franchisee basically quitting the business, locking their doors, going to the landlord or the franchisee and saying, I'm all done, I'm finished. And again, in those cases, the loan is typically not repaid. So we're focusing on negative outcomes for an institution when we look at historical success. Non-renewal is a little bit different. Non-renewal just means that our franchise agreement went to its full expiration term and both parties went their separate way and decided not to renew. Most of the time, we're dealing with a 10-year franchise term with a 10-year renewal, and our 7A product is a 10-year term product. So we're terming our loan to the term of that agreement. A non-renewal means we paid off the loan. Both parties have gone their separate way. And reacquired is when a franchisor will step in and repurchase an underperforming unit from a franchisee. And typically, they're going to continue to pay that note or they're going to pay the loan off entirely as they pull it back into a company-owned location. So that can be a great outcome for both the lender and the franchisor. The lender continues to see the note paid or gets it paid off. And the franchisor has the benefit of not having a location go dark, not having a community see a location close, not having it show up in the franchise disclosure document, all those types of benefits that are seen from the franchisor. But you want to pay attention to those unit outcomes, and that's what we're rating. Go back to the fund report. That's what we're looking at in each of these years. What were the negative outcomes in that system? And then if we compound that success rate, how do we benchmark against all brands in franchising? Point values for this category are only assigned in the top 2 quintiles. So these points are not equally distributed among the third and the bottom quintiles here. You have to have a fairly high compounded success rate to be able to get any points at all in the HSR category. The next 3 categories stay on the unit level, and we look at resale activity level, same-store sales, and unit economics. Resale activity level looks at the transfer rates or the rate at which units are being sold from one franchisee to another. And we're simply looking for a favorable band of activity based on the maturity of the franchise brand itself. So is this a brand that's been around? It's a legacy brand. It's been around 30 plus years. We expect a certain level of transfer activity to happen there. Brand like this, between 11 and 20 years, there's a favorable band of activity there. And really, we're just looking to make sure that our transfer rates aren't that high outsized to its peers and what we would expect from that maturity level. Some of our research has found that an outsized transfer rate can mean that franchisees are leaving and having issues with the system. Doesn't always mean that's the case, but it's something to pay attention to, especially in a new system. We really don't expect to see a lot of transfer activity in a new emerging brand, especially the first couple of years of an emerging concept. So this is sort of one of the canaries in the coal mine that can tell us about what's happening inside the system relative to the franchisees. The next 2 categories really deal with unit performance. And that's, again, same-store sales or average unit revenue, the top-line revenue numbers, and the bottom-line profitability and unit economics. Transparency and availability of information is the most important thing in this category. And brands have a choice whether or not they disclose this unit information at all. Do they give us top-line revenue? Do they give us full P&Ls, which is the gold standard, what we're looking for? They're audited P&Ls, obviously. Or do they just give us nothing? Do they just give us a blank, no financial information? If you go back to this concept, F45, different brand, that we looked at with the item 20 information. If you look at their item 19, it's a total blank. They just say, hey, we don't make any representations about franchisees' future performance, past performance, company-owned franchise units. We give you nothing at all. We rate that right away. So if a brand is giving no information at all pertaining to the unit information, they're going to get a 0 in both same-store sales and unit economics in the fund report. For Fran Data, no information is worse than bad information. If I know I have declining sales or declining profitability, I may still like the loan. I may still like the borrower. I just may do different rates and terms, different cash injection. I might build in more post-closing liquidity. I have things that I can do and levers I can pull. But if there's no information at all, we rate it at a 0. I often get the question, well, what percentage of franchise brands actually give information like this? And when I started at Fran Data in 2013, I know, 11 and a half years of service, we had, I think, about 50 to 55% of franchise brands were giving financials. So about half were giving financials in their item 19. And since then, I think at the last IFA conference, the number was like 75 or close to 80%. So even in the last 10 years, brands have become a lot more transparent. They know that it's important to put out there. They know that banks, lending institutions are looking at this information. But transparency is the most important thing. Do they give us information? Then if they do give us information, what percentage of the system are they actually reporting on? Right? We're getting 90% of the units, or we're getting 15%. And then we go into the actual top line revenue performance, growth over the last 3 years, benchmarked against, in this case, a peer set that we picked to go with this concept between 4 and 6 brands. And we do that in same-store sales, so their top-line revenue and their bottom-line profit. So this is really getting at that unit performance. But first, we've got to get over that transparency hurdle. And one of the things that Fran Data does, and we won't talk too much about this on the call, but one of the things we do is reach out to franchisors to collect this information on behalf of our subscribing banks. So if you have a loan for a concept that is missing item 19, that is not the end of the road, you want to reach out to the brand and facilitate a conversation. And then many times, in many instances, they can provide information directly to you that would be sort of confidential and in the context of the package that you're working on. So keep digging when there's information. Reach out to us if there's missing information. I have my team. In a lot of cases, we can help with that. From there, we go up to the franchisor level. So we talked about unit level performance. Now we're on the brand level. And this is, again, one of those qualitative categories that we hinted at. Franchisor-franchisee relationship. Is the brand suing its franchisees, or are franchisees suing the franchisor? We also go out onto different websites and social media to see, are there complaints online, or any issues with customers, things like that. Any kind of sort of existential brand risk that we might see online, we're going to talk about it here in the franchisor-franchisee relationship section. Recurring revenue self-sufficiency looks at the brand. So it looks at the franchisor level. Remember, we were talking about Simply Southern Restaurant Group, LLC. So the franchisor on the top of this whole thing, and asked, do we take in enough money from our recurring revenue streams, things like royalty streams, right, to pay our ongoing expenses? Or is this a concept that needs to grow, needs to open new units, collect initial franchise fees, collect those royalties to stay solvent? It tells us a lot about where the brand is on the spectrum of growth versus quality. Are we focusing on opening up territory, or are we focusing on our existing franchisees and our profitability and our top line revenue, maybe advertising and things like that? So pay attention to that, and know that newer brands, emerging brands, aren't expected to be recurring revenue self-sufficient because they're just getting on their feet. But this Chicken Salad Chick is an example of a brand that very quickly built up and focused on their system and became recurring revenue self-sufficient for the first time with this fund report. Actually, in the year before, they weren't quite there. And now in the 2023, they were recurring revenue self-sufficient. When we do their 2024 report, we would expect that to continue going forward. Financial statement strength, again, is on the franchisor. And we're looking at the same things and sort of ideas that we were looking at with the average unit revenue and the bottom line profitability. We're looking at the profit and balance sheet positions of the franchisor. Of course, its top line revenue and net income, EBITDA are going to be looked at, but we're really focusing on its long-term and short-term debt positions, its cash flow and cash positions, and do we have enough cash flow to cover our short-term and our long-term liabilities? So we want to make sure to pay attention to those, and that was what we were talking about before when we talked about fat brands and some of the issues that we were able to identify on the franchisor level. System support and expense commitment is one part qualitative, one part quantitative, right? We're looking at the franchise agreement. So we're reading that franchise agreement to look for standard support services that this brand is providing to your borrower, the franchisee. Those are things like obviously the grand opening support, site selection, training, ongoing training and support, anything that's going to be provided by the franchisor. Advertising is included in that too. So what are they providing? Are these the things that we would expect the brand to provide? And then when we get to see through into the financials, how much of their franchisor financial statement are they actually putting into those support measures? And in the case of Chicken Salad Chick, this was affected by transparency. So in their franchisor financials, they really didn't break down the public information. Or they didn't break down the expense information. They did an analysis of, their top line income was broken down into franchise revenues, royalties, and initial franchise fees, but they just lumped all their expenses into one. So we didn't get a see-through into that, and they lost points in that category. Management experience and stability looks at the executive team and asks how many years have they been with this brand, how many years have they been in a similar sector and industry in franchising, and then how many years have they been in franchising as a whole. The most common reason that a brand's going to lose points in management experience and stability is with a split focus of executives. So if we have maybe a multi-unit organization where the chief marketing officer is holding that role across several different franchise brands, they're going to lose a couple of points in that category, again, for a division, a split focus among the executive team. A couple more categories to go. Prospect screening is an important one. That looks at the minimum net worth and liquidity requirements that the franchisor sets up for its prospective franchisees and ultimately the borrowers that you're going to be dealing with. And we look at these minimum net worth and liquidity requirements as a function of the initial investment size of the brand and asking, is this a high barrier to entry, a low barrier to entry? How easy is it to get into the system? What's the strength of the borrower that the franchisor is saying that they're going to have when they recruit franchisees into their system? This is typically not in the disclosure document. This is typically on their website or in another place that the brand would put up. So you got to dig a little bit to find this. But it's important to understand, sure, what are the standards that we're going to see? What's the borrower going to look like when we start doing deals with this concept? But then are we maintaining those standards as the borrowers are coming through the door? Or am I going to look, wait a minute, the requirements are here, but the borrower is here. What's going on? There might be a slippage between what the franchisor executive is saying their requirements are and what's actually happening on the ground. And that can happen through deal referral relationships, broker relationships. There are franchise brokers that help develop franchise candidates and funnel them into franchise systems. Sometimes they're getting a percentage of the initial franchise fee or getting compensated in a different way. Whatever the case may be, if you're seeing those standards slip or not being met, that's a red flag and an alert to get to the franchisor and say, hey, what's going on? You're saying we're supposed to be getting strong borrowers and we're seeing some slippage against those standards. What's going on with the system and their recruiting practices? Franchise agreement assessment is reading the franchise agreement itself. So this is another one of those qualitative measures where we're reading the franchise agreement, but we're looking for any clauses in that agreement that are going to affect your package from a credit perspective. That could be, does my borrower get a protected territory? Do I have excessive transfer fees if I want to sell? Franchisor is charging an excessive transfer fee to transfer that franchise license. Do I have sole sourcing requirements, right? Which means that my borrower has to get all their equipment and material from a specific supplier. Often the franchisor has an interest in that supplier organization. And then liquidated damages is one we're seeing a lot of in recent years, where a closed unit, your borrower franchisee is going to owe 36 months, 48 months worth of uncollected royalty payments back to the franchisor. And that could likely affect your collateral position, your ability to sort of collect on a failed loan if in the event that would happen. So anything that has to do with your package from a credit perspective, we're going to look at in franchise agreement assessment. And the final category of the report is projected unit success. That's taking everything that we've learned so far about this brand and looking at what do we think the next unit of this concept is going to do? How do we think this brand is going to do as a whole into the future? And are there any sector and industry headwinds or tailwinds that are going to affect this? So, what's happening in the space? Were there effects from COVID? Those are the kind of things that you would expect to see in the report in 2021 and 2022, not so much now. But anything that's, outside of the brand, but in the same sector or industry that might affect them, we're going to speak about in the projected unit success category. So a lot packed into that report. It's an incredibly dense report with the fund report. I hope that you guys found that part of it helpful. couple of questions here. Fran data accessible to borrowers if they are interested. They are. It is not available for borrowers. So Fran data, franchise registry, everything that I'm talking to you about today is lender only and lender facing. That includes the fund reports. Keep them within your institution. We don't issue logins to Fran data, franchise registry for individual franchisees. It's just not a market that we're in. We're more of looking at this from the lending perspective and the credit risk perspective from the perspective of the bank, right? And we kind of saw that too when we looked at historical unit success. We're framing unit outcomes in the concept of a deal that was done to that franchisee, not necessarily sort of the overall growth of the system. But good question, and one that we get from time to time about how we may or may not work with franchisees. All right. I promised a couple words on emerging brands. So we talked a lot about fund reports, the ins and outs of that, and how we're going to do that. But as we talked about emerging brands, we sort of told you about why that we wait to do a fund report and some of the unique things. So I want to give a little bit of background on this, and some of this is similar to what we looked at last time, but it bears reinforcing. What does an emerging brand look like really underneath the hood? Well, most emerging brands really are true startup small businesses where it's with a business owner and a spouse or another business partner, 2-person or 3-person team that has established a business that maybe has one location, typically multiple locations, 2, 3, 4 locations of a business, where that ownership group says, to take the next step, to continue to grow this, we need to look at franchising. We can't possibly, with our group, open 10 units, 20 units and do this, but we think we really have a great concept. Franchising is the way to go. So that's what a lot of these concepts underneath actually look like. The problem is that initial founders group doesn't have all the professional experience that is typically needed to grow and maintain a large franchise system. They're going to have typically management or sales or operations, maybe biz dev or finance, but they're not going to have everything down the line. So training, marketing, HR, real estate, legal, IT, all this kind of stuff that's needed to actually run a franchise concept, and especially to run a franchise concept of significant size, which is why we're always talking about slow incremental growth when it comes to emerging franchise brands. You see that little exception there, that little slice of the pie. 14% of emerging brands are actually concepts that are started by existing franchise brands and existing experienced operators. And that is a notable exception to the rule about emerging brands. Good example of that right now in the marketplace is a brand called BWW Go, Buffalo Wild Wings Go, which is sort of a quick serve takeout version, or just wings only version of Buffalo Wild Wings. And oddly enough, there's a little bit of conflict within the system in terms of existing franchisees of Buffalo Wild Wings looking over there and say, hey, wait a minute, they're going to Buffalo Wild Wings Go to get the wings, and they're not coming to my location, and I'm missing out on the beer and the alcohol sales. So there's a problem there. But that's an example of an experienced franchise company and how it's a little bit different than your typical emerging brand. We preach slow incremental growth when we talk about emerging brands. A lot going on this page, but I'm going to just put you in the middle, second bullet point. 72% of new franchise owners plan to grow their brand into a national or international presence within the next 5 years. Takeaway, early stage franchisors often have ambitions that are unrealistic. We didn't look at this slide in this presentation, but I have another slide that says, what's the universe today? What percentage of brands are international or national presences today? And the answer is 18%. So it's the exception rather than the norm, but emerging brand franchisors thinking we're going to be national and international within the first 5 years. Pay attention to that. How are they performing? What does average growth look like in emerging brands? It's, again, slow incremental growth. A brand is going to open, the average emerging brand is going to open 1 to 2 units in their first FDD year. They're going to do 3 to 4 in the second, going to 6 to 8 to 10 into that year 4 or 5, approaching that 5 years 50 units number. Fast growing emerging brands are the exception rather than the norm. They often have digestion issues, what we call digestion issues, down the line, meaning we didn't pick the right location, we didn't pick the right franchisee, we didn't have enough, post-closing liquidity, or whatever we didn't do. We moved too quickly, and now we have some digestion issues down the line. That's why we wait. And further to that, we talked about, sort of hinted at, hey, we don't really often see units closing in the first couple of years of a new franchise brand. Our research has shown us that continuity rates among emerging brands tend to level out in year 4 and year 5. So if the units start to fail, they're going to fail in the 3rd year, and then we see the true continuity rate and the true performance rate among a system in that 4th and 5th year. So those are, again, some of the reasons why we wait and we deal with emerging brands a little bit differently. We still evaluate them. We still look at the same, types of performance metrics. We look at unit outcomes. We still key on terminations and ceased operations other. But again, they may not have the same availability of performance information as we would with, a mature concept. They just don't have that item 19, that unit performance, that history of performance that we would expect. So